providers who did this and did it fast, not only were they able to survive, they did really, really well over the next 6 to 12 quarters. So hear this. Speed matters. And by moving quickly to reduce cost in their MSPs, they were able to not only ride it out, but they were able to take advantage when competitors went out of business, when there were needs for customers who wanted to grow and make some sales investments, some marketing investment.
All right, welcome to Insights as a Service, episode 1 for 2023. And I'm very excited to have Peter Kujawa, the VP of Service Leadership at Connectwise, with me to kick us off. Peter, g'day.
Hello, Brendan. How are you today?
Man, I'm good and I'm excited because the brand Connectwise itself, I think there's a lot of pretty great alignment there really with what Lightwire does. And that, from where I sit, I see you guys looking to help your partners, MSPs, get ahead in any way you can, whether that's leadership insights, generating really interesting industry reports. So that's great. And then also you yourself, I've been speaking to a number of MSPs as we head up to Christmas, as I go and see them for lunches and dinners and that kind of stuff. And virtually everyone knows who you are. So given you such a big deal, it's great to have you on the podcast with us. Thank you very much.
Yeah, my pleasure to be here.
Whereabouts are you?
I'm in La Crosse, Wisconsin, which is western Wisconsin, and right on the Mississippi River Valley.
Nice. Okay, cool. How about for anyone who doesn't know you, which I think is going to be the distinct minority, why don't we just start with a bit of your own personal backstory?
Sure, be happy to. So I have a unique backstory for the MSP world, I think. Most MSP owners start out as entrepreneurs and come out of the technical side of the world. I actually came in with a law degree and a lot of business management and leadership background. And back in 2010, there was an MSP in La Crosse, Wisconsin, that the owner was tired of writing checks into it. It was losing a lot of money. The 12 months prior to me arriving, it did $2.2 million of top line revenue and lost $1.5 million. And my wife and I had been looking to get back to this part of the state, and it was. To me, I thought, well, how hard can the IT business be? I've done a bunch of turnarounds by then. I was CEO of a fintech company for 7 years. As I said, I have a law degree and understand that world. And so I thought, this can't be too tough. I can fix this. And so I came on board back in 2010 and pretty quickly found out that, in fact, it's really hard running a successful MSP. And especially turning one around that's struggling. And so back in 2010, we started to make some tough choices and change some things with the business. And within a year, the good news was we had done $1 million positive swing, which meant we were no longer losing $1.5 million, but it meant we were still losing $500,000. And around that time, we discovered service leadership and started to benchmark every quarter. And within a couple of quarters, we really quickly realized some of the mistakes we were making in our pricing and in our model and our service margins. And really quickly after that, we were able to start turning the business profitable. And we also joined a peer group, and we were a peer group member for about 10 years. So I'm a huge fan of the peer group communities and the impact that those make on companies as well. And so anyway, was there, and we did 3 acquisitions during my time there of other MSPs. We were acquired back in late 2012 and by a large copier dealer, regional dealer that was looking to get more into IT. And that was a great fit. We were able to really successfully grow the business. And so a little over a year ago, October of 2021, I joined Connectwise and Service Leadership to take over leadership of service leadership. And it was for me something that I was really passionate about. It had made a tremendous difference for not only me personally, but for our employees and for all the employees we were able to hire over the years. We went from being about a 15 or 18 employee operation when I joined to being 85 employees when I left it in late 2021. And so I can't overstate the impact that service leadership and the data made on our ability to run the business and to build and grow it and be successful. So it was exciting to me to be able to join and be able to try to spread that knowledge to other companies who are in the same position that I was back several years ago.
So you mentioned there that the benchmarking enabled you to come in with and change a lot of things around, margins, the price points, the processes. Was there a particular order in which you can't fix everything at the same time? You have to make some decisions. There's capacity constraints, whether it's your time or your team size or whatever. What did you focus on first? Was there a particular order that you went through to turn the business around?
Yeah, in all business, there's decisions between low hanging fruit and higher hanging fruit, right? And so for us, some of the low hanging fruit was our product margin. I had been told for over a year that the best we could get was about 13 to 14%. That we at that point we had 5 salespeople and a sales manager, and my salespeople would tell me something along the lines of, Peter, well, I get it. You want to make more money on margin, and we're not making anything. We're losing money, but we just can't. We get shopped. Everybody can go online and price us out against competitors who are online, and this is about all the best we can do. So I said, okay, I don't know the IT business per se. I've never sold IT before coming here, so I'll take your word for it. And at that point, we had about $1 million a year of product margin. Well, we started benchmarking, and in our first benchmark report, I saw that we were at about 13%. Best in class in the industry at that point was at 23%. And so I dug into it and said, well, wait a second, what are they doing different than what we're doing? And I looked at it, and what they were doing was charging more. They weren't doing anything else different. So I came back from our first peer group meeting and said, we're going to change our goal, guys. I think we can do this. Our leadership team all bought in, and we decided to target 23% product gross margin. And so we did. We increased our pricing on quotes. We looked for where we could increase pricing. There were obviously some places we couldn't. But within about 2 months, we were at 23%, and we never looked back. And as best in class went up, today, best in class product gross margin is about 27%. We just continue to ratchet up our goal and measure it every month for success. And for us, doing $1 million of product, increasing 10 points is $100,000 to the bottom line without doing one more bit of work. There's not one more order being written. I mean, literally, you're doing no additional work, and you're getting that additional margin to the bottom line. So, I mean, that's a simple story. Once you start really diving in and looking at your business model on a more granular basis, you start to understand where you maybe need to make some different decisions on compensation on your business model. When Sleek came out, Sleek is Service Leadership's operational maturity level improvement tool. Sleek came out about 3 years after we joined Service Leadership and started a benchmark. What Sleek does is you answer about 150 questions about your business, how you're doing things, how you've structured your support operation, how you do your pricing, how you do your different financial reporting. I mean, really everything about your business. And after you fill it out, Sleek tells you what your operational maturity level is on a scale of 1 to 5. And then there's 5 different areas of your business that it gives you that score on. And there's 40 traits within your business that it also scores. And so at the end of filling that out, it gives you a prioritized action plan. It tells you what good looks like and how to get those better results that you're seeing top quartile companies achieve. And so we went all in on Sleek and started to tackle one at a time, similar to what anybody using EOS or Rocks would use. And the items that came out of Sleek were essentially Rocks. They were 60 to 90 day items to improve. And so, anytime you really fundamentally change a business, it doesn't come from one magic bullet. It comes from the sum of a lot of littles. And so
yeah, totally.
We went in and we were able to just one at a time go in and do 1, 2, 3 things a quarter. And pretty soon you wake up a year and a half later, and you've fundamentally changed the business.
Yeah, I think that's such an important point. I used to get caught up in that idea that there's going to be that one big thing. There's going to be that sort of aha moment where you click your fingers, you finally nailed it, and bang, there's most of your problem solved, or there's your big next product or whatever. But you're absolutely right. It's iterating, right? We work with a flywheel model here, but it's the same thing. Understand, what your what makes you, what your special sauce is basically. If you nail it, what is it that you're doing? And then just look to improve each of those facets of your business over and over and over again. So yeah, I totally buy that. That benchmark data, can you just tell me a bit about how that's sourced?
Our subscribers, we have the largest benchmarking database in the world. Our subscribers every quarter, we have 10 different predominant business models that we benchmark. So we're really comparing apples to apples. Uh, our largest two of those 10 business models are managed service providers, infrastructure managed service providers, and product centric, which is a VAR. Anybody who has 60% more of their revenue comes from product. But in total, we benchmark 10 different predominant business models. And the process works the same. Every quarter, our benchmarking clients put their financial data and some operational data into our system. And then at the end of the quarter, we take about 2 weeks, we lock it down. We determine in each business model who's the best in class. And our definition of best in class is who are the 25% most profitable providers in each of those business models. And so we look first and foremost at profitability, and then we extract about 60 different KPIs out of those most profitable providers. And we provide a benchmarking report book back to all of our clients that says, how did they do? And gets really granular in how they did. And then it also shows how did they do compared to the best in class. So they can quickly eyeball it and know overall how did they do. But even if they're doing well, even if they're in best in class, where do they have opportunities to improve? And so it really helps them understand not just, okay, I made money or I didn't make money. Well, you already probably knew that, right? What's really helpful for operating the business is to understand why. What was it that drove your success? If you were successful, what are you doing right that you should keep doing right? What should be stakes in the ground that is really critical? And if you're not, where are the areas that you most need to improve and need to start your focus? And then every quarter, getting that information and being able to look at it on a trending basis so that you can see over time what are your trends and how are you doing compared to the industry over time.
How much, how do you differentiate between sort of long-term and short-term profitability? I've got this sort of theory I work to that, we're not after short-term profits, we're after good profits, which come from a focus on customer experience. And I think depending on which data set you look at, I think you can build a pretty good case that, profits derived from a constant focus on customer experience provide better long-term shareholder return. But depending on your data set, modeling like the period of time you look over, you could easily say, hey, look, we moved all of our support staff offshore. That dropped wage cost by XYZ, and EBIT went up through the roof for the 12 months to whatever. How do you sort of discern, looking at your data set, between the sort of long-term versus short-term approach?
Yeah, our goal is to build sustainable profitability. Any business can deliver one, maybe 2 quarters, but it's delivering it over a period of quarters, delivering it in a way that is sustainable, that is showing steady improvement. That's what we're really trying to drive to. So for us, we show profitability on all of our charts show an 8 quarter basis. So as
Nice.
long as you have 8 quarters in there, you have to have 4 quarters of data in our system at a minimum to be able to get a report back. So at a minimum, you're going to see how you did over 4 quarters, but ideally you have 8 quarters in there, and then you can really see over the last 8 quarters how have you been trending and where have you been trending up, where have you been trending down, etc. And
Okay.
so, yeah, we're looking at a lot of different KPIs. It's not just profitability. However, at the end of the day, profitability, if you're in the top 25% of providers in terms of profitability, you're doing a bunch of things right. And so you can gut short-term cost out of the equation like you're talking about, but it's going to show up and hit you in other areas negatively. And so what we tend to see with our top 25% is we tend to see the same companies in there quarter in and quarter out. That we'll see about 20% of companies in there that are new every quarter. So, in other words, about 80% of the companies that are in top quartile performance this quarter were also in it last quarter and were in it the quarter before. Bottom quartile is really different. The bottom quartile folks in our last couple of years, and for many quarters, the bottom quartile are 100% of them are losing money, and so they're working just as hard as the top quartile. They're out there hustling just like the top quartile to grow their businesses and add new clients. And in fact, interestingly, when we looked on a 4-year basis, the bottom quartile was actually adding more new clients uh, on a gross basis than the top quartile was adding. So they're both out there selling. They're both working really hard to take care of their customers, but one of them is making money and one of them's losing money. And if you're losing money, you can't live in that bottom quartile, right? I mean, if you're losing money, you're either going to go out of business at some point, you're going to be acquired. And if you are, you're going to be acquired not at one of these high, lofty valuations you're hearing about. You're going to be acquired at a pretty significant discount as a distressed asset. Or you're going to find religion and you're going to figure out what you need to do to fix your business, and you're going to move up and you're going to get out of living in that bottom quartile. Um, so yeah, it's doing it quarter in and quarter out and doing it on a sustainable basis. And so anybody, I mean, you could deliver, theoretically, you could deliver 100% margin. You could go out and sell a bunch of contracts, not pay for any tools and not hire any staff to deliver any results. But
Yeah.
your profitability would not last very long and you might end up in jail.
There is that risk. There is. I think there's a couple of things that come in there. I want to ask about the bottom quartile and what we can learn from in terms of what to avoid, I guess, or the patterns you see that lead to those outcomes. But I just wanted to touch really quickly on the KPIs themselves. Your point is a very fair one around the focusing on profitability ultimately, because I keep seeing those unintended consequences from trying to get too granular with the KPIs. I think you're right. Ultimately, over a data set with enough breadth and over enough time, you're going to find that you see what you need to see from that simple focus on profitability. But yes, bottom quartile. What can we learn? What are you seeing that should be avoided, or that the mistakes that just time and time again have the same outcome?
Yeah, um, it's a great question. I think I would answer it in the opposite way. What do we see consistently with the top quartile? Because the bottom quartile is the opposite, right? Top quartile, what we tend to see is not that they're bigger or smaller. One of the misconceptions that I hear a lot is that I've got to get to a certain size to be profitable or to make the top quartile. And what's interesting in our data set is that we have really large companies that are top quartile, best in class, and we have really large companies that are losing money today and that are bottom quartile. We have smaller MSPs that are out there that are doing things right and they're in top quartile. We have small MSPs that are losing their shirt today financially. So one correlation is not size. We definitely see all sizes. We also, when we've broken out the data, we've looked by geo, we've looked at rural versus urban. We've looked at a lot of different correlating factors, and none of those things correlate to top and bottom quartile. So we have providers in your neck of the woods who are top quartile. We have them that are bottom. We have providers in Europe that are top and bottom. Our benchmarking sample over the years, we've benchmarked in 102 countries. So we've been able to really look at the data and look at what does correlate and what doesn't. What we tend to see is that the top quartile folks are very disciplined in terms of who they're bringing on. So they know who they're a fit for. They've taken the time to define that, and they're not shy about it. They'll tell you right up front during the sales process that this is who we're a fit for. We have a process, and most of them will do a paid assessment. We have a process to determine if we're a good fit for you, and if you're a good fit for us. If that's not the case, we'll tell you, and we'll give you a bunch of usable information back that you can take to the next provider. If you are a good fit, we'll tell you that too, and we'll tell you why. but their marketing people are only looking for a certain type of customer. Their salespeople are only bringing on a certain type of customer. And as a result, there's a bunch of additional benefits that come out of that. They're able to have a much tighter technology stack. So our top quartile folks aren't supporting 82 different brands of firewalls and trying to support everything under the sun for backup. And they're very specific. This is who, if you're on managed services with us, this is the product that we're going to have on for this, and this. And that's all we're going to have. That's all we're going to support. And we're going to, during your onboarding, we're going to do 100% rip and replace. And so what ends up happening as a result of that, Brendan, is they're able to staff their operations with a much higher percentage of level one support people. They have a smaller percentage of level twos and threes. And as a result, their compensation is able to be such that they can pay market rate and still be competitive and still have good margins on their products. They're just able to build a very repeatable set of processes. They're able to document extremely well. When they hire a new employee, it takes them less time to train and onboard that employee because they have been so disciplined in the type of customers they bring on. So I think those are probably two of them. Another common trait of top performers is they have an established value creation strategy. And what I mean by that is that the owners of that business or owner of that business knows within the next 5 years or within the next 10 years, what do they want their MSP to be throwing off for value? And that doesn't mean that it has to be worth a certain amount to be able to be acquired or that they have to go out and be acquired. They might be very happy with the business and owning it and operating it. But what do they need that to look like in 5 years or 10 years? And the importance of that is that that allows them to then back into a series of other decisions that they need to make on the business in terms of investment and risk taking and what type of customer do they want to go after, where do they want to make key investments, where do they want to make bets on the business. If you have no idea what you want to be in 5 years and instead you approach it every year just saying, well, I want to make enough money to make payroll and pay myself a little extra money, your approach to the business is going to be really different than the individual who has the approach of, I know exactly what I want to be in 5 years. This is the rate that we need to grow to get there. This is the profitability we need to be throwing off to get there, et cetera. So,
Right.
so those are really related, but there's several other traits that we commonly see between them.
What you touched on there really is about that positioning to get to that end point, whether it's 3 years, 5 years, whatever. You touched earlier on about that your story where you were 13 to 14% GP. You want to get up to that 23%. That real end-to-end positioning, understanding who your target client is, therefore, what your product stack is, hopefully having that clearly defined and as narrow as possible, how that leads on to reduced wages cost, high profitability overall, above the line, below the line. Really, what we're talking about there is understanding where you can add value, right? That value-based pricing methodology. You can't just try and beat everything to everyone. You can't just try and ship 10. How much do you think the work, the skills shortage that we're seeing globally, I think it's an absolute global thing, right? How much is that turbocharged exactly what you're talking about there? That over the last 2 years, 3 years, just absolutely driven that it's no longer an optional. You have to actually basically pick a lane. Who you're targeting, how you're differentiating in that particular target market, and driving profitability through that. How much have you just seen that ramp right up?
Oh, it's definitely throwing gas on the fire. I don't think the wage situation and the ability to find top level talent was exactly great prior to the pandemic. Those of us who've been in the industry a while, it's been a really tough industry to recruit into for a while, and 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 actually, that's one of the things that's fueling growth. So, for every MSP out there that's struggling to add people and add talented people and retain their people, think about everything an MSP brings to the table. An MSP, you've got the ability for people to take on a lot of different interesting environments, to rapidly advance up, to have great career mobility, to work amongst peers in a fast paced environment. So there's all these positive things going. And if MSPs have a tough time staffing, think of how hard it is right now for a business to try to bring in. If they normally had one or two IT people and they had no career pathing or any of those things, so that's also so the challenge that's there is also fueling a lot of demand and a lot of the growth that's going on. The we've seen the last 3 years have been great for growth, going back to the beginning of COVID. That being said, though, yeah, I mean, if you weren't doing the right things right prior to the situation that's developed with talent in the last couple of years, you went from a bad situation to a really critical situation, and you're probably on the ropes and trying to figure out how to survive as a business if you're not doing the right things right today. So yes, it's definitely had an impact.
It's interesting that that focus point too, though, the just the proliferation of SaaS vendors, right? And every SaaS vendor, particularly in the security space as well, everybody out there with a new product wants you to have your team certified on that product, and that in itself, you can't have everyone certified in everything. You can't have so much spare capacity within your team that they can all take time off to continually certify and stay current with every vendor under the sun. So I guess I still get stuck in the mindset of thinking about 10, your Cisco's, your FortiGates, your whatever, when we think about certification and that focus and picking your vendors. But really, there's such a massive SaaS play out there now that you really have to be selective as well.
Yeah, you really do. And one of the danger zones for every MSP is when they go to a large trade show, because
Mm,
everybody you talk to, it sounds great, right? I mean, everybody you talk to is going to guarantee you 40 to 50% margin, and this is the
yep.
most important thing you can add to your customers, and here's how it's going to make you money, and we'll support you, and it'll be great. And you definitely need to have you need to keep up on your tools. You need to add new technology to your stack and revisit your stack, but you have to be really careful how you do it. We talk about the rule of 15 with it, which is you shouldn't add any new technology in unless you're going to be able to deploy 15 instances of it. So if I have, let's say there's a new security product, and I go to a trade show and I decide this thing's worth looking at, that it's going to solve this one problem we have for this one customer, that this customer's really been asking for it. That's the wrong approach. You've got to look systemically and say, if we take on this new technology, will we be able to roll it out to 15 clients within the next 6 to 12 months? And why 15? Well, the first 5 or so, you're going to lose money on those deployments. Your people are going to be learning the tech. They're going to be getting certified. It's going to take you a lot longer to roll it out to the client. You're going to have to teach your support team about the new product. You're going to have to figure out how to price it, et cetera. So the first 5, you're going to lose money on those. The next 5, you're going to be probably in the neighborhood of breaking even on it. And so you'll have learned some things from the first 5 deployments. You'll have figured out some things with the pricing. You can tweak it a little bit now and adjust it. But overall, you should be in a better position. It's really not until you do that last 5 or so that you're going to actually be able to deliver the product at the quality level that you want to deliver it, deploy it efficiently, and build it into an efficient onboarding, and be able to start realizing some effective gross margin on those services. So you always want to make sure you've got a team of people looking. It's not just a decision being made by your head of engineering or your head of sales or one person. It should really be a team that's evaluating anytime you have a new product
Mm.
and making sure that you're deploying something that in the long haul is going to be the right move for the business, not just it's the new shiny toy.
That cross-functional play is a great point. I also just wonder on that, if MSPs are listening to you and they are taking that approach, if we put our SaaS vendor hat on for a moment, and we look at the latest reporting from CrowdStrike, Zscaler, and others, they're reporting lower than expected sales and longer sales cycles. So it seems to me that perhaps there's more consideration going into these. It's harder to get people to buy into those trade shows. That initial excitement and a more measured approach to taking on these additional products is perhaps coming into play.
Yeah, it could be. And don't get me wrong, I'm not advocating that the MSPs out there not add new technology and not
Oh
build
no.
up their stack. In fact, the data that looked at in the last couple of years has been interesting, and that is the best in class providers out there have added security into their mandatory all-in stack at a much faster rate than the bottom quartile. So they're actually their all-in stack has a much larger slice of security tech in it than the bottom quartile folks do, who tend to still be selling security as a cafeteria style add-on to their all-in stack. So definitely there's providers out there that are making it work. They're adding additional security in, they're adding additional other tools in. The key is that when they do, they're evaluating that technology, and then they're really going all in with it, so that their team, and they're not deploying multiple technologies at the same time. So if I'm back to the example on firewalls, if I decide that I want to go all in on let's say Cisco, and I'm already selling Fortinet, well, I'm gonna A, look at how do I deploy Cisco to my entire base. B, how do I, as part of that transition, what's the project going to be for me to move my existing Fortinet product out? Or vice versa. I might be going from Cisco to Fortinet. I have no opinion per se on the technology. It's just
Sure.
make sure that whatever you're picking, that you don't wake up a few years later and you've got 2, 3, 4 different products that your team is now expected to support. Because if you have 2 products, it doesn't add twice as much complexity. It starts to add exponential levels of complexity, and when you have that additional complexity, that requires a more experienced tech to work on that. It therefore a more expensive tech, harder to find, harder to retain. So there's a lot that goes into it, but definitely MSPs should be bringing on new technology and making sure that they're staying up with what they need to be doing to deliver the new technology. But there's a process for doing it.
Sure. I think so. Maybe it's the process when we think about the SaaS life cycle and just those perhaps slightly below expectation performance in the last reporting cycle. That could be a sign of macro factors as well, but it could also just be a sign of a maturing environment, maturing market where there are more options. A lot of people have already made choices. They're no longer picking something for the first time. They've already picked something. Now, will they change? And that's a much, as you say, that's a much bigger decision. And one I always think about too, like it's easy to put your own business owner hat on. I've got better margins with product X versus Y, and there's so much reason for me to go with this. But how do you incentivize your end users to give a damn about that? How do you incentivize them to move from product X to Y or vice versa? What's in it for them? And to make it interesting for them, worth the disruption to their business, what's that going to add to or take from your margins overall? So, all of those things are probably flowing into a much more difficult sales market for those vendors.
Yeah, I think that that earnings report probably did speak to the level of competition and the maturing of the market. Like the security market for many years has been the Wild West, and you're starting to see some players who are starting to exit that market either through acquisition or consolidation or just shifting gears, and you're seeing others who are more mature and are doing really well in it. And so I think it's a natural progression of the marketplace. Obviously, the need for robust security is not going anywhere. I don't think there's anybody that I've talked to who has said something along the lines of, "Well, Peter, 2023 should be a year where there's less security threats." Right? The threats on both the MSP and on the MSP's clients are going to continue to increase in sophistication, and the amount and the type of technology and the level of it that will be required to mitigate that threat is going to continue to increase. But yeah, I think the market definitely is showing some signs of maturity.
Right. And just talking on maturity then, let's just go back to the OML, the operational maturity level there for businesses. Can you just give me, and apologies if, this is probably going over a little bit of the same ground, so we can keep it high level, but the things that really differentiate one business from another in terms of that operational maturity level, and then just globally, do you see any difference in that level, whether it's, APAC versus the US versus Europe?
Yeah, it's a great question. So the scale is on a scale of 1 to 5, and everybody starts out at OML 1, which is you don't know what you don't know. And so typically OML1 is going to be a startup mode. You're going out, you're just trying to get your business off the ground, you're trying to get some revenue in the door. And so you're much more flexible on whatever technology the customer has. You probably haven't come up with a really mature pricing model. So you've got a lot of different pricing. Basically, any customer who has a checkbook and has hopefully some money in it is a prospect, right?
Yeah.
I don't care how big you are. I don't care how small you are. You have a need for IT. I'm your guy. So you go out, and if you make it out of there, and not every company does, only about 10% of businesses that start up ever survive. I think in the MSP space, that number is probably a little bit bigger. But if you make it out of there, you wake up one day and you've got a bunch of clients who are on a lot of different tech, on a bunch of different price points that probably have different SLAs requiring you to follow a different process to service them. And you might have very likely added a few employees along the way. So you wake up one day, now you got to make all this work, and you're in OML2, which is the really toughest place to live. It's you're truly walking down the middle of the highway, and you've got to figure out how do you get out of that and get into OML3 as fast as possible. When you get into OML3, you've got more of a sense of who your target customer profile is. You've started to bring on customers who are a better fit for you. You've started to really measure things in your business that drive success in both customer experience and profitability. Your employees are probably a little bit happier. They're getting yelled at less often during the day than they were in OML2. So just generally, OML 3.1, 3.2, things start to click a little bit more. OML 3.8, 3.9, things start to get really, really good. And when you get up to about a 3.8 or 3.9, OML 4.0, you're at a level where you're probably at best in class profitability. You're probably in a good position to take on acquisitions and integrate those acquisitions into your organization. Your customer retention should be really, really good at that point. Your employee retention, even during tough times, should be better than your competitors is. So some of the characteristics that define those are how disciplined your target customer profile is, what percentage of your sales are in your target customer profile, how do you define it, how many different managed service packaging and pricing models do you have? Do you have, like a lot of MSPs, a good, better, best? Or have you gone all in and you only have one model that you sell and that's it? How sophisticated is your financial reporting? How quickly are you running financials? Do you have a value creation strategy? If so, what does it look like? How do you compensate your employees? How do you compensate your sales employees? How do you compensate your technical employees? What's the mix of base pay and variable pay, and what's that variable pay based on? Say that 3 times, Brennan. Um,
No, thanks.
so there's a number of different areas. How do you run your service organization, and what are some of the KPIs you use to determine success there? How have you designed your service organization? So really looking comprehensively at the business and looking at how well run is this MSP, and what's this MSP's ability to execute. If they decide they're going to pivot and start taking on something new, what's the likelihood of success of that pivot? And what's the likelihood of success of that executive team being able to implement change within the organization? So there's a lot of indicators that go into it. That's what we use Sleek to do to determine the OML of every business.
Right. And globally, any real difference in strengths or weaknesses?
Yeah, not a lot. There's a couple of areas where we see a little bit of variation. One of those is incentive compensation. There's some
Mm.
countries that incentive compensation is less frequently used, although becoming more common. In other geos, it's more commonly used, and there's a larger percentage of compensation that's variable. Um, but but really, not too much else that's different. The Generally speaking, how an MSP or a VAR is wrong, the things that determine success and determine profitability and quality of execution tend to be pretty similar based on different geos.
Right. Okay. Hey, look, so macro picture, the economy doesn't look in great shape. Well, I mean, it's probably better than I thought it would be at the moment, but it's there's more interest rates, I'm sure, coming, and interest hikes coming, and I shouldn't even open my mouth here because economically I have zero, like no credentials whatsoever. But let's assume we're not going to have a massively soft landing as interest rates keep going up, as the Fed over there where you are, and the Reserve Bank in Australia where I am seek to just cool down the economy a bit. What lessons can we learn from 2008 as we head into 2023 and are not completely sure of the macro picture?
It's a great question. We get asked a lot. Are we in a recession or are we heading into one? And if so, what should I do about it? How well positioned are managed service providers? What I would tell you is there's a significant difference depending on your business model. If your business model is 60% or more product based, and which would lead you to be defined as product centric or a VAR, you're going to be hit harder and faster the event of a true recession than a traditional MSP is. But that doesn't mean an MSP is going to escape scot free. So if you go back and look at the last couple of real recessions, and we'll forget about COVID for a second because that was such an unusual anomaly.
Yep.
The product centric folks, you're gonna see a 45% decline in your product sales within a couple of quarters, within 1 to 2 quarters. And why is that? Well, because it's really easy for a business that's under duress to cancel an order or to not do a project and not do some large upgrade that they were planning on doing. They can easily kick that down the road and deal with that in a year or 2 or 3. So if you're a product centric or a project centric MSP, expect a significant impact very quickly, 1 to 2 quarters, 45% roughly, that you'll see a drop. If you're an MSP, you'll still see that drop in your product orders, but because product is a smaller percentage of your business, it's going to have less of an immediate impact on your business. What you're going to also see, though, as an MSP is about a 20% drop in managed services revenue. And so, where that drop is going to come from is not necessarily just going to be from your customers who go fully out of business. It's going to also come from customers who are scaling back on their own employees, right? Because if your pricing model is taking into account the number of employees they've got, and they just cut 10 or 15 or 20 or 30%, however much of their workforce, well, your monthly invoice to them just went down by that amount roughly as well.
Yeah, that's a
You're
great
also
call.
going to see some customers who are going to come in and just ask for a price cut. I remember having a bunch of these conversations at the beginning of COVID. But every recession, you have customers who come in and go, "Look, we're concerned about the future. We like how you're doing things for us, but you need to cut your price 30%." And you go, "Well, okay, why? And what is it you want me to stop doing for you that's going to reduce your price 30%?" And they'll say something like, "Well, nothing. We just expect you to cut it. And if you don't want to, then we're going to need to fire you and go find somebody who will." And so, you'll have some of those discussions and you'll have to decide as a provider, am I going to do it? Am I going to do it for a quarter to give them a little reprieve, or how are we going to approach it? But anyway, if you add all those things up, on average, an MSP is going to see about a 20% drop. And so there's some things that every MSP should be doing to build up their cash, to have some cash. There's some things that every MSP should look at from a recurring revenue expense coverage. But the most important thing, if your listeners hear nothing else today, hear this. The MSPs that reacted quickly at the beginning of those recessions had to react less dramatically later. In other words, by speed matters, and by moving quickly to reduce cost in their MSPs, they were able to not only ride it out, but they were able to take advantage when competitors went out of business, when there were needs for customers who wanted to grow and make some sales investment, some marketing investment. So the ones who moved right away and said, we've got this person who's in this role that we've been thinking of getting rid of for a while. They're not getting it done. They're out. We have a sales rep who's not productive, but yet is still around. They're out. We have a marketing campaign that we've been doing for 3 years now, and we haven't seen any ROI on it. It's over. We're terminating it, right? Every expense that they could get rid of. And we saw this at the beginning of COVID, that the providers who did this and did it fast, not only were they able to survive, they did really, really well over the next 6 to 12 quarters, or 6 to 8 quarters. So we saw that cost get cut out of the system, and then we saw that cost come right back into the system 2, 3, 4 quarters later when the economy started to stabilize. So if you're an MSP or a VAR out there and the economy turns, we're in an industry that's pretty recession resilient, but it's not recession proof. Be ready to react and know where you need to react and what process you're going to use to analyze that going in.
Those are some great insights and really fantastic point, well made. And I do think it's really interesting that whole the psychology of that. Hey, you need to drop your price by 30%. It's like, well, back against the wall. Suddenly, your whole sort of value-based pricing methodology goes out the window when you're like, well, I can choose to lose 30% or 100% of my GP. Oh God, what do I do? And the other thing I find, just again, sort of a psychological barrier to putting price back up. If you do go for a 1 or 2 quarter, whatever it might be, reduction, you set a psychological price point at which the customer is comfortable with. You have to be able to justify coming back up from there. And on what basis? If you haven't adjusted the services on offer, what is the justification for that? But again, do you want to have some proliferation of bespoke plans that don't include some of your must-haves? I mean, it gets real messy real quick. So
my advice would never be to say, okay, and just give them the 30% unilateral reduction, right? My advice would be, what are they going to give back? So if first of all, the question of why, what are you trying to achieve? Well, we're trying to cut costs for the next 2 quarters and we're trying to build up our cash reserves. Okay. Well, if we reduce you for 30% over the next 2 quarters, then that's an impact on us. We can add that on to your next 2 quarters after that, so you'll pay us proportionally more. Will that buy you enough time to be able to build up your reserves? Or perhaps, your contract is coming up for renewal in 9 months. If we do this, can we extend your contract for another 2 years, and we can increase the price enough over those 2 years to make up for what we're including to cut you for the next 2 quarters, right? So finding out what it is that they're trying to achieve, and then figuring out a way that they're giving you something of equal value back as an MSP. Because otherwise, you're exactly right. You just established a new price point for them that in their head is what they should be paying.
Yeah. And I think, go back to your point before as well about, the MSPs that find deficiencies in their businesses before they have to, while it's still a choice to make, get ahead of the curve. Really, that's the conversation that all MSPs should be having with their clients now. Look, we're not sure about where this is going. What can we do to use technology, the technology that we know how to implement and maintain to drive efficiencies in your business? We're not sure where the economy is going, but just like everyone, I'm sure you want to generate more free cash flow. You want to be in a position where you can make choices rather than have terms dictated to you. So I guess it's just framing of conversation. But just because I don't have you for too much longer, I want to talk about M&A activity. It's been rampant. We've had a couple of years of just FOMO. Everyone's had cheap money. It's been just a really bizarre set of circumstances that has led to this, again, proliferation of just M&A activity. How do you see that playing out in 2023?
We think it'll be another good year. I'm not sure that it'll exceed the multiples of 2021 and 2022 and the deal activity. We're still waiting to get our final numbers on 2022, but we think when the final numbers come in, the multiples will be at or slightly higher than 2021, which was the previous record high. We also think that the number of deals in 2022 will eclipse 2021 when the final tally is taken. and potentially by about 40%. And
Wow.
2021 was a previous all-time record. So obviously a couple of years of red hot M&A activity in the marketplace. And the question is it sustainable? Is it going to continue? What we have seen some signs of is since interest rates have increased, we've started to see some sellers be more reasonable. We think one of the reasons a lot of deals are getting done today is that sellers are being being a little bit more reasonable in their expectation, their deal structure, their role post acquisition, and just in general, they're coming to the table and saying, I want to get a deal done. Let's figure out how to get this deal done now. And some of that, I think, is you have a lot of sellers who are in their mid to late 50s, early 60s, who this is their retirement substantially. So they see the market going through some shaky times and think, "Whoa, if what happens if the market really goes down? I better get a deal done now." And so I think that's part of the reason we've seen so many deals in 2022. But 2023 should still be pretty good. We're still seeing new private equity money coming into the market, and not a little bit. I mean, we're seeing hundreds of millions of dollars coming in from certain private equity investors, all interested in getting into the space because they know it's relatively recession resistant. They know there's a really good recurring revenue model that underpins it. And just in general, there's a belief that the managed service space is a good place to be. So we think, at least for the immediate future, M&A is still going to be maybe not at the level of 2021 and 2022, but it should certainly continue at a good pace.
Have you started to see within your data sets a correlation between the OML of businesses and the multiple gained?
No question. Yeah, no question. What drives higher multiples is a lot of different factors. Everything ranging from strategic buyers are looking for a certain type of MSP to their geographic location that somebody might be looking to get into. All of those things factor in. But at the end of the day, the single biggest determinant of driving a higher multiple is going to be your EBITDA. So how profitable are you as a business? What percentage of your revenue is profit? Um, and then what's the size of your total amount of profit? So some of the buyers out there, it used to be that they wouldn't talk to anybody who had less than $500,000 a year of profitability. Today, we're hearing a lot of buyers won't look at anybody who have under $1 million. And I've got a bunch of buyers I've talked to who are looking for only MSPs that are running 20% profitability, or only MSPs that are at 15% profitability. So if you're an MSP that achieves a certain amount of profitability as a dollar amount, but also as a percentage of revenue, it's going to impact your multiple significantly. So the single best thing you can do if you're thinking of selling in the next few years is figure out, how do I boost my percentage of profitability of my business. It'll open up a lot of opportunity for you. And even if you're smaller, if you're under $1 million of profitability or under $500,000 of profitability, every dollar of additional profitability you can bring to the table is going to make a significant difference in your valuation. So, for example, if multiples are, let's say, just for sake of math, at a low end of the spectrum, and I'm a smaller MSP, and my profitability is average profitability, and I'm going to be able to get a multiple of 5 on my profitability. Well, if I'm an average MSP out there, average MSP is about 4.5 million of revenue and about $450,000 of profitability. If I'm that MSP and I boost my profitability 10%, well, that's going to give me every year about $50,000 of more profit. But if I'm at a 5 multiple, that's going to mean an additional $250,000 when I sell the business. If I'm at a larger multiple, which is more likely, if I'm at let's say an 8 or a 9 or a 10, that additional 10% of profit could bring me another $400,000 or $500,000 when I sell the business. So it's moving the needle a little bit can make a huge impact on not only what you're doing this year, but on the valuation of your MSP if you go to sell.
Yeah, and I guess if you're making those smart decisions, and then also some of that peripheral stuff like contracts and term, sorry, clients and term, uh, maybe some of those standard operating procedures that just allow that repeatability, that clear focus, market penetration in your particular vertical, whatever it might be, that just drives that multiple up by another half a point or whatever. It just adds to that overall picture.
Yeah, yeah, you bet. It's not, I guess we talked about earlier, there's no silver bullet in this business.
Mm.
There's a lot of decisions and a lot of discipline. The biggest difference I see with MSPs that are really successful is they're just more disciplined. They
Mm.
they know who they want to be when they grow up. They are focused on it. They know which customers are gonna, what type of customers are gonna get them there, and they're gonna focus on bringing those kind of customers in. And they're disciplined on firing bad customers as they need to be doing that on a regular process. They just run their business with a greater sense of purpose of what they're trying to achieve, and with more discipline. Again, it's not that they're working harder than somebody who's not as successful. They're both working plenty hard. It's a tough business. It's a tough business to take care of your customers, and the business changes all the time, and it's tough. It's a really hard business to be successful, to run and to be successful. But the knowledge of how to do it is out there. Find it, talk to people, join a peer group like Evolve or Service Leadership. We'd love to have everybody out there benchmark with us. We already have the largest sample in the world, and Connectwise is putting tremendous subsidies into our pricing. You can get our benchmarking and get Sleek for about half of what we charged before Connectwise acquired us. They want to see everybody using these tools, and it's not entirely altruistic. If everybody uses these tools, they'll grow faster, they'll be more successful, which means they'll also need to buy more licensing.
Yep,
So,
absolutely. It's a win-win though.
so, um, but it also fits into ConnectWise's philosophy on community, and really trying to help IT Nation succeed, and trying to get the information out there and what drives success. So
Absolutely.
get help. You don't have to be bottom quartile or median. You can be a top quartile MSP. It's just a matter of making a few decisions and driving some change in your business.
Hey, I'm going to. There's a whole bunch more that I'd love to hit you with because you're an absolute wealth of information, and maybe I'll come annoy you for another conversation in 6 months' time. But I want to hit you with one last question before I let you go, and that is just around economies of scale. So I've got several MSPs I work with who've kind of got to that 100 plus employee count now, where they're having to still scale through people. That is intrinsic to the business. I think itself, you need to scale with people to a certain extent, which sucks for a lot of people in this market when you're trying to find good people to have to scale through that. My question, my very long-winded question though, ultimately is, what are some of the key ways, or are there any sort of tips that you have for enabling economies of scale to kick in, rather than sort of a linear, I add this person, I get this much return after, that we upskill them, and after the sales team get enough, new business to fully utilize that capacity. And then we have a ROI as the sunken costs get returned over time. Are there any smarter ways to go about it that enable you, as you do succeed, as you do get 100 seats, 200 seats, that you really can drive that profitability at a exponential rate?
Yeah, it's a great question. It's a pretty long answer if I answer it really effectively. In the interest of time, I would tell you a few things. Number one is you still need to keep an eye on some of the same KPIs. So, for example, one of the ones that we teach our people to look at, one of the ones in our benchmarking report, is your service multiple of wages. And what you look at with that is you look at your total cost of your service operation, and included in that is all your wages, any benefit costs. And that's going to include everybody who's involved in delivering services to your client after the sale. So it's going to include your project manager, your support desk people, your management in those areas. It's also going to include your VCIO or account manager who's doing post-sale account management. So you want all of those costs go into the same bucket, and you need to be getting at least 2.5x of that cost in terms of services revenue. So as you grow your business, it can be really easy to lose track of those costs, and because those costs start to look different, right? It's when you have 10 employees and you know that these 4 employees are the ones uh, that are doing support of the client, and these 2 employees are doing sales, and these 2 employees are doing back office, and it's a lot easier to keep track of those costs. But as you get larger and your operation becomes more complex, it's even more important, because of the amount of dollars that are involved in it, to still focus in on some of those fundamental KPIs. So today, in our most recent quarter, best in class is actually getting a 2.87 service multiple of wages. But our advice is at least 2.5 is where you want to be. So making sure that as you grow your organization, and at certain size intervals, MSPs are going to look really different. We tend to see an MSP look really different at about 5 to 10 employees. They need to redo their business model. Or somewhere around 20 to 30 employees, we tend to see them rejigger their business model. And then somewhere in that right around 75 to 100, it's going to probably change again. And so the structure of your support desk, the structure of your project teams, your leadership, the level of leadership you have in the organization, these things are going to change, and you're going to need to bring in some new people, because what got you to 25 employee size organization is probably not going to get you to the 100 or the 200. So you're going to need some new people who have some different capabilities of scale. But as you do all of those things, don't lose sight of the basics. Make sure that you really keep an eye on that profitability model and that service model, and what drives success in it as you do that.
Great. I love the data-driven answer. It's the fact that you're giving very clear metrics is very refreshing, rather than sort of more of a high level. Aim for this. It's great. It's very refreshing, and I could not have hoped to have kicked off the year with a better chat. So, Peter from Connectwise, of course, thank you very much for joining me.
Well, thanks for having me, Brendan. And you don't have to wait 6 months if you want to connect again. I'm happy to come on anytime.
Love it. We'll make it happen. Thanks, mate.